In this video, you'll be learning about this topic.
Let's talk about that word balanced. So it's probably easy for the listener here to think about a balanced portfolio being somewhat of a zero-sum game where one part of the portfolio is going up while the other is going down. How does it all just not net out to zero?
It's understandable why that would be the result that people would think you get to. The reason that's not the case is that each of these assets has a positive expected return, meaning its mean, its average is, let's say, 6 or 8% a year, something like that. And if you're diversifying across all of them, then a good environment for one means that it does better than its average. And a bad environment for another means that it does worse than its average. And because its average isn't zero, it doesn't net out to zero. It nets out to the average across all the assets. And so when we say it outperforms or underperforms, we don't mean versus zero, we mean versus its average. And so what you're trying to achieve is to get as close to the average as possible and minimize the variation around that. And by balancing this way, we think you can achieve that.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.